Hi, good evening, everyone. Thank you again for joining us this evening. I'm James, market strategist at Smart Securities. Welcome to another episode of the Talk Stock with James series. Our topic this evening is second quarter earnings review. Are e-commerce players such as Alibaba, Pinduoduo, and Sea Limited staging a comeback? I think their second quarter earnings look quite interesting, so I decided to cover them in this seminar. So here we go. I'm also conducting this Talk with James series every alternate Thursday, 7:30 p.m. The next one would be 28th of September. Okay, let's get the disclaimer out of the way first. The presentation is presented to you for education and sharing purpose only and does not constitute to any form of advice. Past performance is not indicative of the future performance. First thing first, let's talk about Alibaba. Regardless how bad Alibaba fundamentals are, investors have to know that it's still one of the most beloved stocks among value investors. So in terms of the price movement, when the share price is low enough, there is always a group of value investors come in and snap up Alibaba stock. And Alibaba always attracts a lot of rumors. When the share price is low, you will often see news about Ant Financial's IPO resurfacing. And if you have been listening to me long enough, you will know that I don't quite like Alibaba. But because it is a stock highly driven by news itself, I won't give it a sell recommendation, even though I don't think Alibaba future is bright. Now, let's talk about the latest quarterly earnings. The news headlines say that Alibaba posted strong revenue growth, and it looks indeed not bad at first glance. In the latest quarter, on a year-on-year basis, Taobao and Tmall Group grew by 12%, digital commerce grew by 41%, local services grew by 30%, China grew by 34%, digital entertainment grew by 36%. The total revenue on a year-on-year basis grew by 14%. So most of the items here provide double digits growth. So if you compare the first quarter and the second quarter earnings, you will notice a significant improvement in the revenue growth itself, especially considering there were many items here provides you negative year-on-year growth in the first quarter itself, whereas second quarter saw many double-digit year-on-year growth. Unfortunately, if you look closer, you will realize that something is amiss here. So I actually asked my fellow colleague to compare these two quarterly earnings and tell me what is wrong about them. And he's quite good. He told me the answer I want exactly. So I'm posting the same question to you. Does anything here change and raise your concern? So probably you'd like to take the next 20 seconds to look at it closely, and I will review the answer. Okay, so the answer is all other revenue. Interestingly, there is a new item in the revenue segment in the second quarter 2023, which is all others revenue. And this all others now accounts for 19% of the total revenue, with only 1% year-on-year growth itself. So what is happening here is that Alibaba has reorganized its revenue structure. They have moved some of the revenue that previously belonged to direct sales and other, and place it under all others in the latest quarter. The rationale behind this move is that some of the items in the category have shown slow growth. So this is why they decide to actually mask it under all others. This includes Sun Arts, 河马先生, Ali Health, Linsin Games, In Time, Figgy, and other businesses itself. Collectively, this segment only grew by 1% in the latest quarter. In essence, Alibaba is getting a bit creative in accounting by grouping all the underperforming segments together. This is important because now the second largest item in this revenue segment is only experiencing 1% growth rate. The largest item is still the customer management itself. So the question here is, if you start grouping the underperforming segment together this quarter, does it mean that in future, should there be more underperforming segments, they will be grouped together as well? So overall, what I'd like to share here is that Alibaba has made an effort to make his revenue growth appear good on surface. So A for effort. Next, I also like to look at the biggest item here, customer management under Taobao and Tmall group revenue segment itself. Customer management essentially refers to the third-party business, or so-called 3P itself, where the third-party seller lists their products on Alibaba platform and sell them, and in return, Alibaba receives commissions and earns advertising fees to assist these sellers in promoting their products. On the other hand, direct sales represents Alibaba first-party business model, where Alibaba purchases products from other suppliers, store them in the fulfillment center, and sell them on their platform. So what is happening here is that the first-party business grew by 21% year-on-year in the latest quarter, whereas the third-party business only grew by 10% year-on-year. Personally, I don't quite like Alibaba direction in prioritizing first-party business. To put it simply, first-party business has lower profit margin, whereas third-party business has higher profit margin itself, but is growing slower than the first-party business at the moment. Now let's also talk about the fourth largest revenue contributor, Ali Cloud. Ali Cloud accounts for 10% of the total revenue of Alibaba and is still the fourth largest cloud provider in the world. However, the revenue growth itself is not exciting per se. In first quarter this year, it only grew by -2% year-on-year. In the second quarter, it grew by 4% year-on-year as well. In comparison, Amazon AWS growth is 12%, Microsoft Azure is 26%, Google Clouds is 28%. In April this year, some US senators urged Joe Biden to ban Huawei Cloud, Ali Cloud, and Tencent Cloud, as they believe that all these cloud providers pose a threat to US security. So I don't think Ali Cloud future is bright. Ali Cloud can only become a regional player. Maybe their main customer are Chinese companies, but the business can never scale as big as other global cloud players like Amazon. But probably the earnings won't matter much if Alibaba could list some of their spin-off units soon, which eventually can push up the Alibaba share price itself. Alibaba currently is planning to list their logistics and grocery businesses within the next 18 months. However, there are rumors suggesting that the valuations of the grocery unit, 河马先生, is disappointing. Therefore, they may not proceed with the listing of the grocery unit 河马先生 in the near future. If you remember my previous Alibaba webinar in April, I actually say that I don't quite like Alibaba CEO and Chairman Daniel Zhang Yong. Subsequently, in June, he has stepped down to focus on the cloud business. And a few days ago, surprisingly, he quit his job. So he is now totally out of Alibaba. And this makes investors worry that the Ali Cloud IPO might be delayed. So this is why recently you can see on Daniel Zhang Yong's departure, Alibaba share price actually plunged a bit. Hopefully, the new Alibaba CEO, Eddie Wu, will prove to be a better CEO than Daniel Zhang Yong. He recently also said that Alibaba will be user first and AI driven. However, I thought these are the areas of focus for many businesses nowadays. All in all, if you are interested in China e-commerce players, I believe Meituan and Pinduoduo have stronger business models. And based on technical analysis, if the bulls really want to push up Alibaba share price, the first target price would be $160. The next target is $200. They may push the share price along with some of the spin-off IPO news itself. But in Chinese, I would refer this as 逃命潮, meaning to say at those price level, I foresee strong selling interest for those Alibaba shareholder itself. Okay, now let's talk about Pinduoduo. Pinduoduo is the third largest e-commerce platform in China. To put it simply, Pinduoduo business model is to subsidize merchants in order to attract as many merchants as possible to list their products on their platform. But what Pinduoduo really cares about is the advertising revenue. Pinduoduo wants all those merchants on board to spend on advertising on the platform. The advertising revenue typically accounts for maybe 70 to 80% of the total revenue of Pinduoduo. As of now, Pinduoduo has a market cap of 124 billion, whereas Alibaba market cap is standing at 222 billion. So Pinduoduo is now half the size of Alibaba in terms of the market cap, and I believe that I believe that their market caps will come closer to each other in the future itself. So basically, Pinduoduo business model is quite simple. The business model is all about third-party business, and the third-party revenue is growing stronger. Pinduoduo third-party revenue as a percentage of Alibaba's third-party revenue stands at 65% in the latest quarter. If you look back at the first quarter of 2020, it was only 14%. So this significant increase has contributed to the exciting growth over the years for Pinduoduo itself. In the latest quarter, the third-party revenue growth is 66%, whereas Alibaba's third-party revenue is just 10% in comparison. And now let's look at profit margin. In the latest quarter, the gross profit margin was 64% and the operating margin was 24%. In comparison, in the same period last year, the gross profit margin was 74% and the operating margin was 27%, a bit higher. So the overseas expansion, I would say, must have hurt the margin a bit. But still, the profit margin remains high enough to support its aggressive overseas expansion efforts, which is Temu. I would say that Pinduoduo has enough money to fund Temu's overseas expansion. Temu now operates in more than 38 countries, and lately Temu expansion focuses on APEC region, such as Japan, Malaysia, Philippines, South Korea, and some of the Southeast Asia countries as well. But country like US may still be a tough market to penetrate. You will often find news about US Congress saying that Chinese retailers Temu and Shein regularly violated US import tariff law itself. There is also reports saying that Temu is losing an average $30 per order as it throw money at trying to break into the US market. So Temu operating in US might be losing a lot of money, but it's okay to me. I think what Temu tried to do here is that it wants to expand itself into as many countries as possible now. If a particular country does not bring in profit, it will instead focus on those countries that will. So for a country that doesn't bring profit, maybe it will exit the market in the future, in the near future. Recently, there is also a short sale report by Greasy Research accusing Pinduoduo of having spyware in their Temu app that extracts extensive user data without their knowledge. But again, there is no way for laymen like us to verify that information. So, and I wouldn't be surprised if Temu got banned in US. Having said that, this also supports my view that US is a tough market to penetrate. For me, if you really want to own a US e-commerce player, the best one is still Amazon. Anyway, Pinduoduo has gone up 34% or $26 since I last talked about Pinduoduo in my June webinar itself. And I previously used DCF model to derive a fair value of $124 back in June for Pinduoduo share. So if you compare it to yesterday closing price at $98, it represents an upside potential of another 26%. All in all, there is nothing much to say about Pinduoduo earnings result. It was good. Basically, the earnings were in line within expectation, and Pinduoduo's robust second quarter performance also suggests to us that Pinduoduo is the most promising player in the China e-commerce landscape itself. And to me, I would say that there is little brand loyalty in the e-commerce platform. As long as your merchandise listed on their platform is cheap enough, customers are willing to come to your platform to shop. But definitely, e-commerce players like Alibaba and JD.com still attract the customer who wants brand products. But I also think that Pinduoduo, with this kind of growth rate, has the potential to become the second largest e-commerce player in China. Currently, Pinduoduo is the third largest. Its Temu expansion to me seems okay, even though Pinduoduo does not disclose any number yet. And the overseas expansion is necessary because you need the expansion to sustain your top line revenue growth, to create a growth story, to attract growth investors to invest in your company. And if Temu is a success in future, I think Pinduoduo may spin off Temu and get Temu listed, probably in US. why you want to spin off Temu? Because Temu doesn't want to be associated with China too much due to geopolitical risks. Overseas investor may give Temu a higher valuation if Temu is spin off from Pinduoduo. So that is the rationale. Okay, now let's talk about C Limited. Personally, I like C Limited due to the Southeast Asia exposure. I think if you like Southeast Asian market, C Limited is still one of the best stocks to gain exposure. But why? C Limited is trading 89% below its all-time high. And if I could blame it on one thing, on why C Limited share price dropped so much, the reason would be the decline of Garena, the gaming business itself. We need to talk about Garena. C Limited called the entire Garena business as digital entertainment. The Garena segment reached its peak in the fourth quarter of 2021 at $1.4 billion in terms of revenue, but it fell 62% to $529 million in the latest quarter this year. Operating income for Garena, on the other hand, fell 65% from its peak of 858 million to 296 million in the second quarter this year. And no one can be sure where the bottom is. Bookings, which is essentially the gap revenue plus the change in digital entertainment deferred revenue, is also coming down from 1.2 billion in the third quarter of 2021 to 443 million in the second quarter this year. This is concerning because it tells you that less people are willing to spend on Garena. During its earnings call, C Limited CEO Forrest Li said that both quarterly active users and quarterly paying user grew quarter on quarter as Free Fire shows sustained signs of improvement in user retention and engagement. So this actually raises hope that the Garena decline has reached its bottom. Indeed, quarterly active user overall saw a rebound quarter on quarter, but if you look at the number year-on-year basis, quarterly active users fell 12% year-on-year. And the quarterly paying user ratio also declined from 9.1% 1 year ago to 7.9% in the second quarter this year. So overall, this presentation slide tells you that there is lesser players on Garena and less people are willing to spend money on Garena. The silver lining here is Garena will soon launch a modified version of Free Fire in India, which should boost Garena's revenue. So basically, Free Fire is now banned in India. However, as I mentioned earlier, Free Fire is at the end of its gaming cycle. So I don't quite believe that the relaunch in India for Free Fire will have a significant impact. The only consolation I can find is that Garena's contribution to the total revenue has been decreasing over time. So the gaming revenue contribution to the overall revenue has been decreasing over time. This means that analysts and investors nowadays may not be so sensitive to the poor performance from Garena itself. Garena is the biggest and only weak spot for C Limited. We can observe this in terms of operating income, where Garena has seen a significant decline when comparing the second quarter of 2022 to the second quarter of 2023 from the operating income itself. However, the e-commerce segment and the digital finance segment have now turned profitable. Let's talk about the e-commerce business first. On a positive note, the e-commerce business is doing okay. For the past 3 quarters, the revenue were above 2 billion. But again, the revenue growth is slowing down. Previously in 2022, the revenue increased by 200 million every quarter. But for the last 3 quarters, the revenue is stagnant at 2.1 billion. And the operating income also came down from 100 million 2 quarters ago to 65 million in the latest quarter. So the outlook for Shopee may not be as exciting in the near future. Nevertheless, Shopee has the highest market share based on the number of e-commerce website visits in many Southeast Asia countries itself. If we were to look at EBITDA as a percentage of the gross merchandise volume, is still negative 2.7% in 2022. However, in the developed markets, the EBIT take rate is around 5 to 6% compared to negative 2.7% for Shopee now. So this actually suggests to you that there is significant potential for Shopee going forward. But moving forward, Shopee may face a lot of competition in the Southeast Asia market. Recently, we've seen the news that Alibaba injects 850 million into Southeast Asia unit Lazada. And from my previous slide, you also know that Temu is also entering Southeast Asia as well. Therefore, I will say that it is quite challenging for Shopee to increase its take rate. Especially, as I mentioned earlier, I don't believe there is a strong brand loyalty in the e-commerce platforms. If another platform like Lazada is selling the products at a lower price, or if Lazada offer more voucher, customer will simply purchase the products from Lazada. Let's talk about the digital financial services. My fellow colleague, again, is quite excited about the future prospect of the digital finance business. I am neutral. I reckon that I probably don't understand the Southeast Asia digital financial business enough to understand its full potential. I think the growth rate for digital finance services is okay. But I reckon that like e-commerce revenue growth itself, digital finance services fail to make up the decline of the Garena business. For example, Garena revenue was 1.4 billion and operating income was 858 million at its peak. And digital finance service revenue, right, was 427 million and operating income was 121 million. Digital finance services got a lot of work to do to make up the loss in Garena. And I think that these past 2 years, other than Visa payments business model, payment stocks like Square, PayPal, Orion are not doing so well, looking at the fact that their share price keep dropping. So I don't think any analyst is willing to stamp a high valuations on the payment stock now. So naturally, the valuation for fintech segment in C Limited won't be so good. On a side note, even if Ant Financial uh, goes goes public itself, I will not be so excited because payment industry um, doesn't seem to be so good at the moment, partly because of the fintech crackdown in China. And if we were to talk about the exciting upcoming IPO, I will be very much interested in Shein IPO or ByteDance IPO if they ever go listed. And I shall end my presentation here. If you have not subscribed to our channel, please do so. Okay, and let's now proceed to the Q&A sessions. If you have any questions, please type it out in the Q&A box and we'll try to answer all of your questions. Okay, I see no questions today. If you have any questions, you can actually uh, comment on comment sessions when I upload the video on YouTube, and I will try to answer from there. Okay, so thank you everyone for attending the webinar today. Okay, thank you, and I hope to see you again 2 weeks later. See you soon.